to talk about the performance of US markets, how they were yesterday and how they are acting today. After FOMC meeting minutes, we are joined by Bhavik Mehta, joining us from Century Financial. Bhavik, thank you so much for joining
Thank you,
us
family.
today. And yesterday, we had the meeting minutes of the Fed, which contained a lot of data, and it was hawkish. How did markets, in your view, receive the FOMC meeting minutes, and how did it interpret it in light of the performance of the US markets? Dow Jones, we are seeing repeated peaks, and we saw a lot of misunderstanding in how the markets reacted and understood the Fed meeting minutes.
We have started this year on a very negative tone, I would say. The FOMC minutes, again, the markets were somehow getting complacent. By December 31st, that Fed is going to pivot at some point of time. Maybe the FOMC minutes would indicate something regarding the Fed pivot. But if you look at the minutes, they were completely hawkish. The Fed has absolutely clear to the markets that inflation still remains the biggest threat for them. Now, this is despite majority of the inflation expectations coming down. So what basically Fed is trying to do is it's trying to tell the markets that if there's a recession, something that they have themselves created, the market should be ready for it. And they are underpinning a strong message that they expect further correction in asset prices, including equity, housing, and other big bubble markets. So overall, if you see the fall in stocks like Tesla and other tech sector, even the layoffs in the major tech companies, it just start off the signs of probable oncoming recession in the United States.
Mr. Bavik, end of last year we saw declines in the US dollar. Now, with this meeting minute by the Fed, which was not it was not strange to see them fighting inflation, wanting to restrain it. Do you think we will see the dollar is going to see more gains for the first half of the year?
Definitely. So our best bet is dollar. The correction in Euro USD is high time. Euro typically rallied, basically because whenever it dipped below the parity, as soon as it dipped below parity, so the dip buyers were back in action. But as and when you see, big risk taking in the markets, definitely there's scope for dollar to rally from here on during the H1 of this year.
Many indicators that the Fed rely on to read inflation and how their decisions are being reflected, whether in being hawkish or less hawkish in the future. Some data might not go as the Fed wants. I'm talking about in unemployment, wages. How will the Fed be able to deal with this situation despite the hawkish? Yet some numbers are not reacting enough and are still very positive, too positive.
True. So if you look at the Fed's preferred inflation gauge, the PCE price index, which typically accompanies with the GDP data, that has basically peaked near the 5 to 5.5 percentage. So despite a clear trend of inflation probably going to come down, and despite clear signs of recession followed by high unemployment rate, the Fed is not budging its stance. So what the Fed is doing, in our guess, is it's trying to keep its peak neutral rate well above the long-term inflation expectations. So even in a scenario where, let's say, unemployment rate peaks above 5% and the PC inflation comes near 3%, the Fed still wants to maintain a high buffer of interest rates, something in the range of 5 to 5.5 percentage, so that during the next recession, it has enough buffer to cut the rates.
The Fed hiked 50 basis points in December. And before that, we saw four successive hikes of 75. What do we expect now in February? Meeting 50 or 7 or 25? Where is the Fed headed?
And most probably, Fed could go for 25 basis point. And now, Fed has already communicated that the peak in the neutral interest rates is somewhere around 75 to 100 basis point from the current levels. So, in our guess, it might go with a slow rate hike of 25 basis point for the subsequent meetings, so as to show a little bit of dovish trajectory.
What about the time? Although it is early to talk about this, but when do you expect them to pivot in their policies and move into cutting interest rate, in your view? At least in which quarter or which half year, and briefly, please.
Right. To be very frank, majority of the market participants are expecting some kind of Fed pivot and even cutting of interest rates this year. But we do not see the Fed cutting rates this year. Even if the US economy goes into recession, the early estimates are not before the Q3 or Q4 of this year, when the US economy is expected, to give back-to-back negative prints. So I would say rate cut would typically not happen before the start of the next year.
Bhavik Mehta, thank you so much for
Thank you.
having joined us from Century Financial. Have a nice day. We hope to see you again. Thank you so
Thank you.
much.